Hello, everyone, and welcome to yet another episode of Fun and Learn Fridays with 5 Paisa. I am Deepika Asthana, your host for the evening. I am sure that many of you know that investments के लिए mutual funds सही हैं. लेकिन क्या आपको पता है आपके लिए कौन सा mutual fund सही है? Mutual funds में काफी सारी categories होती हैं. The three most common ones are equity, debt, and hybrid. So today we are going to be talking about the hybrid category with none other than the lady who always tells it like it is, Ms. Radhika Gupta, MD and CEO Edelweiss AMC. It gives me great pleasure to introduce Radhika today. In a career spanning over 15 years, Radhika has worked at one of the leading consulting firms, that is McKinsey & Company, at the world's largest systematic asset manager, AQR Capital, founded her own alternative asset management firm, Forefront Capital Management, and become the youngest and only woman CEO of an AMC in India, and is a board member of the Association of Mutual Funds in India. She has a powerful and purposeful voice, which she is using to ensure that people make more informed investment decisions. Welcome, Radhika. It's a pleasure to host you today.
Thank you so much. Thank you to you and the 5 Paisa team for having me.
Pleasure. All right. So, Radhika, let's just get right into the mix of it. Hybrid funds, as the name suggests, is a mix of debt and equity. There are debt hybrid funds, there are equity hybrid funds, and then there are balanced advantage funds. In your opinion, what makes balanced advantage funds the Shah Rukh Khan of the category?
Okay, good. I'm glad you said Shah Rukh Khan. So I think outside of my personal love for Shah Rukh Khan, I think why I think BAFs are very relevant is I think one, there's a BAFs share two categories, two qualities I like. One, they appeal to a large, they serve the needs of a wide range of investors. And secondly, they serve that need over time. So they're timeless and they're wide in their appeal. I think to just hark down to what a BAF is, very simply said, it is a fund that has both equity and debt. That amount of equity and debt, however, varies. It could be 30 equity, it could be 80 equity, depending on market conditions. So in that sense, it is your very basic need. It has the two most basic asset classes, equity and debt. And this whole point of कब equity में कितना होना चाहिए, how much to be invested, market कैसे time करना है, it takes care of that problem. In terms of outcome, I think most of us in our investments are looking for two very simple things. One, we don't want a heart attack when markets really correct. 5-10% correction, all of us I think are mature enough to handle. 30-40% is a thoda sa different matter. So I think that protects extreme downside well. And secondly, we want some wealth creation. So, we are all aspirational. We want to beat inflation, etc., etc. So I think BAF solves these twin objectives well, which is why I think it is such a wholesome category.
Excellent. So, to say it in a very filmy way, basically, zor ka jhatka dheere se lagta hai, and everybody can take that dheere ka jhatka. Like BAF helps you take that jhatka dheere se, which is the equity market.
झटका तो लगेगा ही equity में, लेकिन तुम धीरे से लगेगा तो then you will continue in the game. अगर बहुत जोर का झटका लगता है, so then what happens with equity investors is they retract back permanently.
Correct. And that's a big risk. I think you must have also experienced it, that I think all of us at a personal level also, कि जैसे ही markets start falling, our ability to stay in the markets and our conviction that things are over the long term going to work out, it just goes for a toss. It's very difficult to actually stay put in a falling market, right?
And so much of the game is staying put. So much of the game is actually staying put. If you earn 2% less, but you stay put over a longer period, really is the game in investing. So if BAF can help you stay put, then, it's solving a lot of problems.
Correct. Perfect. So I think BAF is a very it's Shah Rukh Khan of the category, well known. Most of the fund houses have BAF as well. So there are some key phrases that always pop up when we talk about BAF. It's an all-season fund. It's your partner in market ups and downs. Can we discuss a little bit? I know you touched upon how the jhatka dheere se lagta hai, but maybe a little bit in detail about how BAFs are actually managed and how is this allocation moving from debt to equity in the good and the bad times?
Okay, so I think it is very important to understand how to evaluate a BAF, and to understand how to evaluate a BAF, you have to understand the three things that drive BAF. And I'll tell you them in order of importance. So there are three things that drive a BAF: how to choose between equity and debt, what happens in equity, and what happens in debt. And I've named them in these three orders because these are the three orders of importance, although all three are very, very important. How to choose between equity and debt in most established BAFs, this is model driven. So a fund manager is not taking a discretionary call. There is a formula by which this call is taken. That I think is the heart and soul of a BAF. A BAF, regardless of whoever runs it, should not depend on fund manager discretion, because nobody does a particularly good job at market timing. Humans are inherently biased. When you put it down to a formula, whatever that formula is, as long as it's a more timeless formula, it works. So that formula could be something like price to earnings ratio. It could be market momentum. There are many ways to sort of cut that cookie, but essentially there's a formula. You've got to understand what the basis for that decision making is, and there's no good and bad answer here. It's more important to understand what the outcome is and in which markets it will work and what it will not do. Sure. The second thing is to understand how the fund manager manages the equity component. That is similar to understanding a large cap fund or a mid cap fund, but the equity philosophy. Are they holding 20 stocks? Are they holding 50 stocks? Are they holding growth companies? Are they holding value companies? You need to understand all that. And the third is to understand the fixed income component, because you have fixed income investments. You want to make sure your fund manager is not taking material credit and duration risk. You're not investing in a credit risk fund here, so you should not have any surprises.
Okay. So I mean, what really comes out to me is that the key lies in the way the shift happens.
Yes.
So the equity is managed in a way maybe an equity fund will be managed. The debt portion is managed in the way a debt fund would be. And of course, we need to be careful about, like you said, the duration risk and the credit exposure. But the key which differentiates a BAF, like one from the other, would be the way the shift happens between debt and equity.
Yep.
Right. And is it also safe to say that the way the shift is managed will also impact how well protected you are in a market downside?
It will impact what kind of markets you do well in and what kind of markets you don't do well in. So let me give you an example. If you have a BAF that says, so one approach to run a BAF, and let me simplify this, is if you were driving a car and you were driving on a very crowded highway, and it's raining, etc., you'd say, okay, I'm going to slow down. So basically, if markets are very poor, I'm going to slow down. And if the road is clear and it's sunny and it's the national highway, I'm going to pick up speed. That's a momentum approach. That will protect downside in extreme markets when there is a trend or really rising market. But in flat markets, it will not do as well. I'm going to say that. There are other BAFs that use this PE-based ratio. Now, the PE-based ratio works in some markets. It doesn't work in other markets. So both of them protect downside, but what kind of markets? Markets are also very nuanced, which is why it's important to read this. A lot of BAFs now have documentation on that formula and methodology, which you should ask for.
Okay. Interesting. So it's not only about the downside, but it's also about how well you can capture the upside.
Absolutely. It's a twin problem. You don't want just something that's downside protection.
Correct. Then you can just go for a pure debt fund, I suppose. Right. Okay. So another thing which is commonly said about BAF is that it is for every kind of investor. For example, a risk-averse poet and an aggressive kabaddi player both would be able to reap the advantages of BAF. Is that true? And if it is, then would love to know how exactly that works.
So I think, and an IFA friend of mine told me this, I think BAF is a little like aloo. You can use it in multiple ways in your portfolio. So if you are a conservative investor, it can be the core of your portfolio. Instead of doing equity, you just do BAF because it gives you lower drawdowns than a large cap equity kind of fund. It gives you large cap like outcomes in the long term, but with less jhatka and volatility.
Sure.
If you are a risk-taking investor, it is not going to meet your mid-cap and small-cap needs, but what you can do is have BAF as a part of your portfolio and supplement it with an SIP into a mid-cap fund or a small-cap fund for your risk-taking. So this is one part of your portfolio and that's another part. So in that sense, yes, it meets both needs. It's very much like Aloo. It can become whatever you make of it. It has that quality. For instance, in my own personal portfolio, I use BAF as the core and I'm a moderate investor, conservative to moderate investor. But I know that I want some wealth creation that comes out of mid and small cap. So I add a mid and small cap and an international fund SIP on top of it. But BAF remains the core of what I do.
Okay. So BAF is like the anchor of the portfolio.
Yeah.
Okay, so from that perspective, Radhika, one more thing which I've heard frequently about BAF is that if you invest in a BAF, it automatically takes care of asset allocation for you. But what we just discussed is that it should be a part of your core and not entirely like will take care of asset allocation. So maybe we can discuss a little bit on that.
Yeah, it's a good question. So BAF is called an asset allocation fund, and it does do asset allocation. Now the asset allocation is model dependent. So you broadly know what asset allocation it is. For some people, it may work as their complete asset allocation solution. For some people, they may need a supplement. For instance, BAF doesn't have international equities. So you can take a BAF and it can be a domestic asset allocation and you can add a little gold and international equity component. What it does do very well is your equity debt allocation, it handles completely. If, however, you still feel it's too conservative, you can layer on top of it a little bit.
Okay. So as a standalone,
BAF gets right though, is it makes sure you're never completely into equity or you have some, so BAF makes sure at least you have a component of debt in their portfolio, which a lot of investors forget, which is very important. And it makes sure you always have a component of equity in your portfolio. And so in that sense, it takes care of asset allocation.
Interesting. So in that sense, I mean, whatever I'm hearing from you and what I've read about BAF, I think for any investor, let's say a 25-year-old investor who is just getting into starting the investment journey and wants to dip into equities, BAF would be a great starting point for such an investor?
Actually, yeah, and age sort of independent. Anyone who's just wanting to get into equities, BAF is a very good starting point. Because what happens is, you need to season as an equity investor. And, we saw it in this recent small cap correction, right? You're a first time small cap investor, the asset class falls 15%, you suddenly start panicking. But BAF is like the shallow end of the pool, right? It lets you get your feet wet in equities. You make a few mistakes, you understand your risk appetite. Then if you want to take it up, you can, but it's a great starting point. And what I love about BAFs is in 3 years, Deepika, your outcome will not be bad. So if you just check rolling returns of different products in equities, pure equity funds, in 3 years, you could have a negative return. In BAF category, if you're even a 3-year investor, the chance of you making negative returns is virtually negligible, which I think for a starting point investor is a very good outcome.
Indeed, that is, so I was not aware of these numbers actually. So that is very interesting because generally when we think equities, we always think 5 to 7 years plus, right? But if through BAF, we can get the relevant equity exposure and benefit from it, let's say in like 3 to 5 years time, even from a goal setting perspective, I think it's very valuable for investors, not just for their retirement goals or low goals, which are 15 years out, but maybe goals which are also 4 to 5 years out.
Absolutely. So BAF, equity investors come to me and say, I have 3-4 year money. And I say, equity is definitely not a 3-year thing because you can lose money. If you want to do something in the 3 to 5 year zone, BAF is a really good fit. And if, by the way, you choose to do that with SIPs, it's even better because whatever volatility is, you dim it further. So I've been doing an SIP into BAF for the last 5-6 years with my monthly salary. You may not believe my compounded return is close to 15%.
Wow, that's a good number. That's a good number because over a period of time, even equities, I think those times when equities gave in upwards of 18-20% have gone, right? I mean, the markets have become far more systematic. So to get that sort of returns is, I think, every investor's dream, really. But perfect. So Radhika, another thing, because it's such a talked about category, right? There are a lot of things people say about it. I've also heard a lot of people say that BAF would be an ideal replacement for FD. which got me thinking. I mean, how accurate would that be, or inaccurate is that?
Well, I'm going to be very, very honest because I love the category so much, but I also be very honest myself. There is a right and a wrong word. BAF is not an FD replacement because FD is technically fixed income, right? And in fixed income, over 3 years, you don't lose money. In fact, if you withdraw an FD prematurely also in 1 year, you're not going to lose money. You might have some breakage penalty, etc., but you're not going to lose money. So to compare something with 50% equity to FD, I think is a little unfair. However, over 3 years, you will have a pretty good outcome in BAF. As I said, the probability of you losing money in BAF over 3 years is pretty slim. I think what BAF is, it's a good, to the question you had asked earlier, it's a good starting point for someone who's looking to move from FD to the next level. So it's not a replacement to equity, but for the FD to FD, but for the FD investor, it's something good to consider if they're looking to get out of equity and try the markets. And as I said, BAF can also be used for SIPs and also SWPs for the source of regular income if you do it the right way.
So Radhika, can we talk a little bit about SWP, what that is like for our listeners? What exactly would it entail setting up an SWP?
So everyone's familiar with how SIPs work. You have monthly, installments that go. SWP is kind of the opposite. It's a way to get your money back in a monthly systematic manner, systematic withdrawal plan. And you basically set up an SWP amount. So Deepika says, in this fund, I want a 6% equivalent SWP a year. So that's 0.5% or little less than that a month. And I get that money back every month or quarter. And you can set this up with the AMC. So it has a frequency, it has an amount. My recommendation on SWPs and BAF is one, don't start your SWP on day one. So you invest in a BAF and you do an SWP because you need to give it time to accrue returns for you to take anything back. So let 2-3 years of returns happen. Secondly, don't set up a very aggressive SWP. So if you go set up a 10% SWP on BAF, in my view, that is a bad idea. If your BAF is going to give 10%, set up a 6% SWP. Keep a little margin of safety now so that you're not eating into your capital.
Sure.
And that way it serves, even as a older person, it serves your monthly income or quarterly income.
So to that extent, and I'll go back to my previous question about serving every type of investor, it also meets multiple requirements then. I mean, depending on how you approach BAF, whether through an SIP or SWP, or even a systematic transfer plan, starting from your 4 to 5 year goals, even your retirement goals, which then you can supplement your retirement income with an SWP that you have accumulated over a period of time. It will serve all of these requirements.
Absolutely. So, I mean, as I said, young investor who's a first-time equity investor and wants to start, salaried professional who wants to do an SWP and is thinking, where do I park my money, and doesn't want to debate every month equity, non-equity, etc. Basic asset allocation for a moderate investor, income taking back for a retiree or that kind of investor, which is why, going back to the beginning of the show, across categories and across time, if used the right way.
If used the right way. Okay, so on that note, let's also talk about the risks in BAF, since we discussed if used the right way.
Absolutely. So I think first you have to realize that BAF has equity. It has on average 50% equity. This is reality, which means equity can lose money.
Right.
So even in a month, if the market is down 30% in a month, and you think your BAF is going to be down 1%, that's not right. BAF could be down. A good outcome in a 30% down month is a BAF that is down 10, 12, 15%. A BAF that's down 25 when your market is down 30 is a little too aggressive for a BAF. So I think that you have. Now the market is not down 30% in a month very often, but these are realities, right? A BAF is not a 1 to 2 year investment. A BAF is a 3+ year investment. So 1 year BAF can have negative returns. That is important. And monthly income, as I said, has to be very smartly used in BAF. Moderate amount after some period of time. Otherwise, you start investing and thinking, I'm going to get money back today. That doesn't happen. Of course, keep a watch out for the fixed income quality of your portfolio.
Right. So that is a very important point actually, Radhika, because often when we talk about anything which has any component of equities, we only focus on the equity risk, right? But if anything, the market has taught us over the last 2 years, or the investment climate, that there's enough risk in debt as well, and maybe that also needs to be looked at with a finer lens than previously. So that is very interesting. Great, Radhika. I'll come to a question which I've always wanted to ask you, because I consume a lot of all your tweets and LinkedIn updates. I find them so authentic and real. So I've always wanted to ask you this. Which is your favorite author or book?
Oh God, this is like a full webinar. Someone should. I'm going to disappoint everyone because I don't read many finance books, but I read a ton of literature. Like I read a ton of literature, and I grew up abroad, so I read literature from around the world. So if you read, I love Khaled Hosseini's A Thousand Splendid Suns. I read
Right.
more than the I love a lot of the literature out of Africa, especially the stuff that Adichie has written. It's fantastic. In India, I love Rohinton Mistri's work, especially some of his historical fiction. So essentially, my favorite genre is historical fiction.
Oh, lovely. So, I don't know, would you have read William Dalrymple as well? Because he's one of my...
No, I haven't.
Okay.
I haven't. I should now.
Yes, I would highly recommend it, especially if you like historical fiction, and his, the way he writes about India.
Okay.
It helps you see it through a very different lens. So I will recommend it to you.
Historical fiction it's a beautiful genre. So I like Isabel Allende. It comes out of Latin America, so you get to see the history of different countries, in the world through human characters, which I think is beautiful. Yeah.
Lovely. Okay, so I know this was about...
That was a not finance and not BAF answer. So
I was just going to say, but it's like I've been in the markets for more than 20 years or about 20 years. And when I see an opportunity, I grab it. So since I have you here, and this is a question I've been wanting to ask you for the longest time, I said, this is my opportunity.
There you go.
So perfect. I think on that very, very high note, let me try to summarize this session in the best way that I can. So BAF as a category is doing well. It it gives investors, it's a mix of equity and debt, and it gives investors exposure to both asset classes. But what is even more important about BAF is the way it is managed, which means the way assets are shifted from equity and debt, and how the exposure is managed is probably more important than how well the equity and the debt are doing. Another important thing about BAF is that while a lot of it look at it as giving us downside protection when markets fall, but as Radhika pointed out, it's equally important to see that the BAF is able to capture the upside as well, because ultimately we are in it for the returns. Thirdly, we also discussed how it is for every kind of investor, especially for those investors, irrespective of age, who are looking to dip their toes into equities. Equities are known to be higher risk, but they can get exposure to equities and benefit from equities through a BAF, because the debt exposure kind of reduces that the jhatka which equities can sometimes bring. More importantly, BAF is not risk-free in nature. So investments in BAF are also subject to some amount of risk. So for an investor who is looking to make, who has a 1 or 2 year goal, maybe BAF would not be the right investment. And also we must look at the credit risk of the debt portfolio, because when you're investing in a BAF, you're investing in equity and debt. Thus, you need to be conscious of the debt risk as well. And we also discussed about Radhika's favorite genre. She likes reading historical fiction. So that is my summary. But Radhika, please, any closing notes that you would like to share?
No, I think thanks for doing this. As I said, I think BAF is a great product for these times when people are confused. Markets feel all-time high. You want to be cautious, and yet you want to enjoy the benefits. I think it's a very good product to think about at this time. And I'm so happy more conversations about BAFs are happening, because I've been like a broken record on this topic.
No, superb. So which is why, Radhika, it's important to have these conversations, right? When they come from authentic and expert people like you, and the way you simplify things, I think we must also understand, I think investors actually, our finance is so complicated and jargonized, right? So it's so important to break it down. And You break it down beautifully, actually. So,
Thank you so much.
thank you very much for coming on the show and sharing this with us. And I hope everyone enjoyed this session. Until next time, thank you.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.